leakage and locked box deals, clear definitions and phrasing. Welcome. In this short lesson, we'll demystify locked box deals, a common structure in M&A that gives both parties pricing certainty. A locked box uses a fixed economic cutoff date. The buyer agrees the purchase price based on the target's balance sheet at that date and treats subsequent cash flows as the buyer's benefit or loss. The purchase price is therefore locked to the target's cash and debt position on that date, so there are usually no post-closing price adjustments. The overall goal? Provide certainty and a simpler post-close process so transactions finish faster and with fewer disputes. In a locked box deal, leakage means any value that leaves the target between the locked box cutoff and signing or completion, reducing what the buyer actually buys. Leakage can be cash withdrawals, transfers of assets, or disguised cost shifts that move value out of the group. Practically, leakage reduces the buyer's intended economic position because the price was set earlier and didn't account for those outflows. Because leakage undermines fairness, it must be clearly defined and quantified in the agreement to avoid later disputes about whether a transaction constituted leakage or was permitted. Leakage shows up in predictable ways, so it helps to be familiar with typical examples. First, unauthorized cash distributions or dividends paid to shareholders directly reduce the target's value. Second, related party payments and intercompany transfers can shift value out under the radar. Third, excessive management fees or suddenly incurred liabilities might be used to strip value. Finally, asset sales below market price or outright gifts to insiders move economic benefit away from the buyer. Spotting these patterns early helps parties draft protections tailored to real risks. A practical leakage clause combines a broad net with precise carve-outs so parties understand what is and isn't allowed. Start with a broad definition that captures any value transfer, then add specific exclusions so routine business actions aren't unfairly labeled as leakage. Include a clear list of included items, for example, cash outflows, transfers, and certain expense reclassifications, and separately state permitted actions such as pre-agreed payments or ordinary course costs. Use precise language and avoid vague terms so there's less room for differing interpretations later. Concrete wording reduces debate. For inclusions, try phrasing like, any transfer of value from the group to external parties to capture most leakages. For exclusions, carve out phrases like, ordinary course payments under agreed budgets, so routine operations continue. Always specify the exact time window, for example, from locked box date to completion, so parties know the relevant period. Finally, define how leakage is measured, gross amount or net of taxes, whether liabilities reduce or increase the figure, because the measurement rule determines the buyer's remedy and prevents arguments about calculation. When leakage happens, buyers need contractual tools to recover value, and sellers need certainty about exposure. Typical remedies include a contractual indemnity, requiring the seller to repay identified leakage. Parties can provide a set-off against the purchase price or maintain a holdback escrow to cover potential claims. Strong pre-closing covenants and representations reduce risk by committing the seller to preserve the business. Finally, include audit rights and an agreed verification process so the buyer can investigate suspected leakage, and both sides accept a transparent method for resolving discrepancies. Negotiating leakage terms is about clarity and commercial balance. First, be specific. Narrow wording minimizes later argument. Second, use examples and schedules, sample payments, or a list of permitted transactions, so intent is visible. Third, balance buyer protection with seller needs by permitting reasonable pre-agreed actions and defining materiality thresholds. Fourth, agree dispute resolution steps in advance, such as an expert determination process or defined timelines for claims, to resolve issues quickly without derailing the deal. These steps keep negotiations pragmatic and forward-moving. To wrap up, leakage is any unwanted transfer of value out of the target after the locked box date that reduces what the buyer actually acquires. The solution is careful drafting. Define inclusions, exclusions, and measurement rules clearly so both sides know the boundaries. Build remedies and verification, indemnities, set-offs, holdbacks, and audit rights into the deal to manage risk. In short, clear phrasing and agreed procedures save time, money, and disputes, making locked box deals work as intended for both buyer and seller.